Hi, I'm Susan Lipp, Editor-in-Chief of Trust and Estates, and I'm here today with Greg Singer, who is Senior Vice President of Capital Group Private Client Services. And Greg is writing an article for the September issue of Trust and Estates on how to invest in emerging markets. So Greg, can you discuss a little some of the recent trends that you've noticed?
All right, thanks, Susan. We see a substantial change in the emerging markets investment opportunity today. For the past decade, it's been largely led by state-run infrastructure spending. We believe in the next decade, the opportunity is more going to be about consumer goods and healthcare services to the expanding middle class. And interestingly, from investment implication, this actually really means that the emerging markets index is going to continue to diverge dramatically from where we think the core investment opportunity is. So let me talk a little bit about what's the same, what's going to be different and why, and what are some of the investment opportunities that we see right now.
Okay, sounds good.
One thing that's the same is we continue to expect emerging markets economies to grow far faster than the developed world, but that growth rate will be slower. So from double-digit growth for most of the last 10 years to expect to be more about 7% right now, still substantial, but with risk to the downside. And interestingly, despite that superior economic growth, the emerging markets index has trailed the developed world for the last 5 years and still has not recovered to the pre-crisis levels. We think that's in part to the composition of the emerging markets index. The emerging markets economies are home to many more materials and commodities-oriented companies. These companies benefited dramatically during the big growth in infrastructure, but also been punished disproportionately as that infrastructure growth has started to slow down. As we think what the next trend might be, is we're really looking closely at the growth of the middle class. Right now, China, for example, represents only about 4% of the world's middle class population, but we believe that by 2020, there will be the biggest middle class in the world. And what's one of the first things that you do when you emerge from poverty and into the middle class is you start taking better care of yourself and start indulging in the smaller luxuries. So we think the investment opportunity from this growing middle class is going to be a lot of consumer goods and healthcare companies. And frankly, we actually believe most of those companies are in the developed world index, where a lot of the dominant branded consumer goods companies and the largest healthcare and pharmaceutical companies are located. In fact, healthcare only represents 1.5% of the emerging markets index. So the opportunity to serve these consumers just isn't there right now. I think another reason that the developed world has done so well over the last 5 years relative to emerging markets index as well, is that much of the revenue growth that comes in the emerging world is actually served by developed world companies. In a study by MSCI, they saw that about 40% of the revenue in the emerging markets is actually served by companies that you can invest in through the developed world. And we actually think that trend will likely continue. So how does this change occur? Let me just give an example from China. There's a new government in China. This new government has recognized that a lot of the infrastructure has been built and they want to shift to the consumer. They've been tightening credit to some extent to prevent loans to further infrastructure projects from growing as fast. And then they're making some steps to support this shift to the middle class. They've raised minimum wages. They're reforming a lot of the social security safety net. And they're talking about reforming the hukou system, which actually controls where you can live. And by reforming the system, they can support more urbanization, and urban consumers spend much more than rural consumers. And then when we look at Chinese companies, our analysts are focused on, are there companies that are headquartered within China that can benefit from this trend? So instead of the typical very, very large banks that support a lot of the infrastructure growth, we're looking at their emerging consumer companies. So for example, we're looking at a company that makes car seats. Right now, China has no car seat law, and very few parents own them. But in Brazil, when they first put in a car seat law, growth of car seats was 15. The car seat adoption grew 15 times. All right, in the areas of cosmetics, right, the Chinese consumer has a different skin type. A local company can potentially better serve them, but there's no real infrastructure to distribute it. So we're looking at a company that's marketing itself through YouTube as a way that they can reach the emerging Chinese consumer. And in the case of healthcare, the few companies that are based there are largely making generics. But some of them will reach enough scale and enough research expertise that they can start creating innovative new drugs or medical devices. And that's where we think there's going to be some emerging opportunities locally. So overall, a real change in investment opportunity, A lot of the investment opportunity might be companies that aren't headquartered in the emerging markets, but also the types of companies within the emerging markets are going to be very, very different going forward. And so that's where we think investors really have to focus to still take advantage of the continued strong economic growth, but you might not find that exactly in the emerging markets index.
Right. All right. Well, thank you so much for coming in to discuss your article topic. And you can learn more about this by reading Greg's article in the September issue of Trust and Estates.